We think women need to talk more openly about money because money really matters. It shouldn't be embarrassing or confusing. Join the conversation. We'll be discussing a whole range of topics which will help you get comfortable with your finances. Money Matters. Brought to you by AJ Bell.
Hi, and welcome back to the Money Matters podcast. I'm Laura Suter.
And I'm Danni Houston. This episode is dealing with the number one issue that I'm asked about right now, and that is mortgages.
Yes, it is all over the front pages at the moment, and we're going to talk a bit about what's going on right now and why, but also what to expect when it comes to interest rates.
We're also going to dig through some of the ways that people are trying to cope with the fact mortgage costs have shot up, including choosing really long mortgages, which could mean you won't be done paying for your house until after you retire.
Plus, we keep saying if you're a first-time buyer or your mortgage is coming up for renewal, you should really talk to a mortgage broker. And that advice still stands because obviously everyone's personal circumstances are different. But we thought rather than sending you to a mortgage broker, why not bring one to you? So we've got one on the pod today. Keep listening because we've been quizzing the brilliant Charlotte Tollett, a mortgage broker at Meet Margot, an app which puts a broker in the palm of your hand.
She really does have some great tips, so do stay tuned. But first, let's start with the basics. Since December 2021, the Bank of England has hiked interest rates 12 times in a row, and that has taken the base rate from an incredibly low 0.1% all the way up to 4.5%. Now, that is as we record this in early June 2023. It's all because the Bank of England is trying to bring down inflation, which is now in single figures, but it is still way off the bank's 2% target. And there was a surprise that saw core inflation, which is not the headline number that we're all talking about. That was 8.7%. But core inflation, that's the bit that strips out the volatile stuff like energy and food. It actually went up in April to 6.8%. And that had the effect really of catching everybody on the hop and raised the expectation from markets that the bank still has a lot more interest rate hikes to come. Before that inflation number, I think most of us were assuming maybe one more interest rate hike. Now the expectation is we could see rates go as high as 5.5% by the end of the year. That's 1% extra. It is not nailed on by any stretch of the imagination, but this is the expectation that really plays into what's called swap rates. That is essentially banks hedging their bets on where they think interest rates will be in 2, 3, 5, 10 years' time. And if a bank thinks that it might have to pay more than it thought, that's when fixed rate mortgage products tend to become a whole lot less attractive. And that is exactly what we've seen since those shock inflation numbers. In fact, taking a look, Moneyfacts was saying that the number of mortgages available at the start of June fell to a 3-month low. Now, that's because some providers were pulling some of their products, others pulled them, put them back on, but at much higher rates. And all of this just means that people looking to take out a mortgage or to remortgage will find monthly payments will be a whole lot more expensive than they were. And I'm talking to the tune of hundreds of pounds a month. Some cases I've come across, those increases can be above £1,000 a month more. Now, of course, that depends on how much you owe on your mortgage, how much equity is in your property, and the time of length left to pay that mortgage.
I think that's so useful, Danny, to kind of explain. We know that interest rates are going up. We know that has an impact on mortgage rates, but it's so useful for you to kind of connect the two and how that actually works. And you're right, there are so many people looking down the barrel of much higher repayments, myself included. And I was hoping that by the time I came to remortgage, rates might have dropped down a bit. So if it's any solace, those of us that are talking about it all day, every day, have no greater insight on where interest rates are going to go than the average person on the street. And so I think that's quite frustrating, isn't it, for homeowners, is that the goalposts keep moving, how much interest rates are going to go up to, when they're going to start to be cut, all of those things that have a big impact on our mortgage rates. just keeps changing, almost seems by the week. But one of the ways that people are trying to make their mortgages more affordable is to extend the length of the time on their mortgage. So typically we think about a standard mortgage being over 25 years. So that's the length of time it takes to repay that borrowing. But people are now taking out 35 years or 40-year mortgages. Now, they were always available, but they're now becoming much more popular. So we've got some new figures out from an organisation called UK Finance, which is the trade body for banks. And that shows that the number of first-time buyers taking out a term over 35 years hit a record high in March. And it now actually accounts for a fifth of first-time buyers. It still is also rising among those remortgaging. So now 8% of people who are moving home are also getting a term of 35 years or more. Now, one of the big reasons is that the longer period that you're borrowing over, the smaller your monthly repayments. But it has a big impact on the total cost of that debt. If you're borrowing over a longer period, then that means that you've got more interest adding up on it. So monthly costs are lower, but total costs much higher. So it's a bit of those kind of short-term win, long-term pain kind of situations. I did some figures because I thought it might be useful to have some examples. So someone who is buying a £350,000 home, but with a 10% deposit, if they borrowed that over 20 years, then the total interest that they pay on that borrowing is £125,000, just under that. But if they extended that term from 20 years up to 35 years, then the interest adds up to more than £230,000. So I think that gives you a really good example of how that little change that you might think might not make so much of a difference actually has a huge overall financial difference. But having said that, the difference between the monthly repayments over those terms is about £550. So the longer term, that 35-year term, is going to cost you £550 less each month. That is a huge amount of money, and money that some people just might feel they do not have in their budget, and so they have to opt for that longer term. And with interest rates obviously having risen, it's the only affordable way for some people to get on the property ladder or to remortgage. So I don't think it's a case of saying really super long mortgages are definitely bad. I think it's just a case of being aware of the financial implications of them, which if you're using a broker, they will help to spell out those.
It is so hard to make decisions at the moment. And you're right, for a lot of homeowners looking to remortgage now, they've never experienced interest rates like this because we've had ridiculously low levels since the financial crisis. And this is a real eye-opener for a lot of people. I'm going to make you a bit sick now because December 2020, I decided to remortgage. And for the first time, I went for a 5-year term because I thought it's not going to get much lower than this.
Oh.
So I'm sitting kind of...
I don't want to hear that, Danni.
comfortably. But I was in the complete opposite situation in 2008 because I had a fixed rate mortgage, which was quite expensive, and interest rates came right down, and everyone else is dropping onto the standard variable rate and doing a celebration dance, and I'm still paying quite high interest rates. So I get people's frustration, and decision making is really difficult, and you try to make decisions that you think are going to be the right decisions for you. And a lot of these changes, and some of my friends have been talking about extending the term of the mortgage or maybe going for an interest only mortgage. And then they say, but I'm only going to do this while interest rates are high, and then I'll look at changing that back when interest rates fall. And that is great if you've got a plan like that. But the problem is when you get used to paying a certain amount, you might not go back to paying more. And I'm thinking particularly if you're going down the interest-only route, you need to have a game plan on how you are going to pay off that home, or whether you've decided that you'll sell it and downsize or whatever. You have to be aware that you can't just hope it's all going to be okay. And I also think a lot of people at the moment are just sort of eyeing the date that they need to remortgage coming up and just praying that rates are going to come down. But I think the problem is every indication at the moment is we don't expect them to come down. Not this year, maybe not next year. So I think we're in it for a while.
And I think if we kind of look at a lot of the different trends in the mortgage market, what we've got is two quite troubling trends together. One is that people are buying later in life, and that's just because buying a property is so much more expensive. It's much harder to save for that deposit. And so people are getting on the housing ladder, into their 30s, their mid 30s, rather than in their 20s. But then we couple that with this trend to opt for super long mortgages, so 35, 40-year mortgages. And what you end up with is people paying off that mortgage into their retirement, or perhaps even delaying their retirement because they've still got that big mortgage to pay off. So I think it's a case of kind of thinking about the longer term implications of that, but also the fact that if all the time you're repaying that mortgage and you've got that big monthly cost going out, that's stopping you being able to put money into other areas. So into your pension, for example, or into another savings pot for the future. So it's really tricky, I think, when you're getting on the housing ladder to think about what you're going to want to do when you're 65, for example. But I think there is an element where you have to slightly get into that mindset and think about the long-term implications of these things.
I think there's some figures which came out this morning, which for first-time buyers, and you were talking about the fact that first-time buyers, a lot of people are getting onto the housing ladder later because of the fact that house prices are so elevated compared with where they were 10 years ago. Well, for the first time in 11 years, house prices have recorded the first annual fall. Now, that's according to figures from Britain's biggest mortgage lender, the Halifax. So it found that a typical house price had fallen by £3,000 this last month. That's compared to a year ago, and more than £7,000 compared to the August peak that we had. And another lender nationwide said that it had recorded actually a deeper fall in house prices, down 3.4%, the biggest decline, they said, in 14 years. Now, whatever the number, it is a downward trend. And really the expectation is that rising rates and higher mortgage costs will impact the market further, but it is still crazy expensive. So the average home, according to Halifax, costs now £286,532. And if you're also trying to save up for a deposit and you've got crazy high rents, then that makes it really difficult. And of course, then first-time buyers who are also graduates with student loans, there is a possibility that a 40-year mortgage could end at about the same time that student loans payment end too, Laura.
Yeah, student loans are also changing from this year and effectively going to make them more expensive for a lot of graduates. And the term over which you have to repay it is extending from 30 years up to 40 years. And so that means that you will be repaying the loan for 40 years before your debt is wiped out. So someone who has got a 40-year loan repayment plan and graduates, in their early 20s, then buys a property in their 30s, could ultimately be paying off student loan debt and their mortgage in their 60s, which is just, I know everyone talks about we're living longer, we're going to work for longer, but for lots of people that might not be an option, or they might not want to. And it's really stacking up the costs for people later in life and taking, a decent chunk out of their income that could otherwise be set aside for savings and investments. We're actually going to have a podcast coming up shortly on those student loan changes, how to handle student loan debt and the impact of those changes. So check out that podcast episode when it's up in the summer. But I think it's just all of these things are a bit doomy and gloomy, but I think it's just thinking about them, considering the impact of them and thinking, okay, well, if taking a super long mortgage is the only way that I can get on the property ladder now, but I've got a plan of how to make it so that I'm not paying off my mortgage still in my 60s or delaying my retirement. It's really hard to think so long term about financial decisions you're making today, but your future self will definitely thank you for it.
Spreadsheets. That's what you always advise, isn't it?
If there's ever a question, then the answer is always spreadsheets, if you ask me. But I don't think people share that same love of them as me.
Crazy. They're all crazy, Laura. Look, we've already covered the whole home buying process if you are a first time buyer. So go back and listen to that episode if you haven't already, because it's got some great jargon busting terms there. But back to this episode, because Laura has been digging into all the options for those remortgaging, what you need to think about, talking to Charlotte Tollett, a mortgage broker at Meet Margot.
First up, let's talk interest rates. So there's lots of people that are going to be coming off those cheap fixed rate deals, whether they've been on a 2-year fix or a 5-year fix. What could they be paying at the moment, and what kind of rates could they expect to pay if they were coming to remortgage today?
Okay, so interest rates. Yeah, so for those who have been watching interest rates for the last couple of months, they'll know it's been very rocky. And we have had a couple of interest rate rises with the Bank of England base rate. So the last rate rise was on the 11th of May this year. So the Bank of England base rate is currently set at 4.5%, which has had a knock-on effect on mortgage interest rates. So if you do have a remortgage renewal coming up within the next 6 months, whether that's you coming off a 2, 3 or 5-year fix or possibly longer, one thing I would say and what to expect is that you're going to have an increase within your monthly payment. Now, how much that's going to increase by determines on your mortgage individually. So there's a couple of factors that are going to determine that. Now, one thing is your loan to value. So your loan to value is a ratio of your mortgage to the amount of equity that you have within your home. So the lower the loan to value, the better, because that's less risk to the lender, which will they'll offer you a lower rate of interest. If you've got a higher loan to value, it's seen as a higher risk for the lender, and they could possibly offer higher interest rates for you. So the loan to value is what's going to determine that as well. Another thing to think of is what interest rate you're going to be coming off and what interest rate you're going to be moving to. So we've had historically lowest interest rates on record for quite some time, and back in 2021 it was less than 1%. So for those mortgages that are coming up for renewal, they're going to have quite an impact within the monthly mortgage payment. So what I would advise is starting to look at this possibly 6 months before, so you can forecast and know exactly how much your monthly mortgage payment is going to go up by, so you can budget for that increase rather than leaving it right to the very end and having a shock of how much it's going to go up by. If you can speak to a broker, look at the interest rates that are available now and possibly lock in on a deal, you can then budget and forecast for that increase upon your renewal.
And lots of people who are going to be remortgaging for the first time will have forgotten that entire getting a mortgage process that they did last time, particularly if it was maybe 5 years ago. So what do they need to bear in mind, and what do they need to have ready before they go and speak to a broker?
That's it. So if you are remortgaging for the first time, or like say a 5-year fix, possibly quite a long time ago, there's a few things to get ready. Now, the first thing to do is find out when your mortgage end date is. So check any mortgage statements, contact your lender, or look at your online mortgage services. Some lenders have that available. And it might be sooner than you think. So although you might have moved in a property on such a date and you think, right, I've took a 2-year fix, it's going to end exactly on this date in 2 years' time, it might not be the case, because every mortgage product has different start and end dates. Could actually end up, depending on where you completed within that month, you may end up with slightly longer than 2 years, for example, or slightly less. So it's really important to find out when that is, because it might be sooner than you think. Know your outstanding balance and your remaining term. I'd say be proactive. Shop around early to protect yourself from any interest rate rises. So lenders allow you to lock into a new deal to 6 months in advance. That tends to be because mortgage offers last around 6 months. There's a couple that can be around 3 to 4 months. It just depends on the lender. But by shopping around early, you can protect yourself against those interest rate rises. Another important factor would be to determine your property value. So that's where the loan to value comes in, as we've just mentioned. Research recent sales in your area. Use tools like Zoopla, Rightmove to help you find the property price. There's also the house pricing index, which is what a lot of lenders use. It's an automated valuation system to determine the price of your home. Now, you can find that on your statement, on your online services, or by contacting your lender, and that will really give you a guide of how much your property is going to be worth. And again, we want that loan to value to be as low as possible to give you access to the lower rates. It might also be worth consulting a broker, because we know the affordability and the criteria inside out. So it increases your chances of approval by finding the right deal. And sometimes brokers do have access to exclusive deals that you might not have access to directly as a customer. So it's always worth a check and get an advice from the whole of the market.
Loads of useful stuff there, thanks. And lots of people might think it's just easier to stick with their current mortgage provider, just find a new fixed rate deal with them and transition to that. But are you better off sticking, or are you always better off shopping around and seeing what other providers could offer?
So I would say don't settle for the first mortgage deal that comes your way, and it's really important to consider all your options first. A rate switch with your current lender, it might be faster and quicker, and you think, oh, they know me, so it's going to be easier. And it can be in some cases. But you are limiting your options by doing that to just one lender's product. So it could mean that you're missing out on a more competitive deal with another lender elsewhere, which means it could save you quite a bit of money over that period of time. So by looking around, shopping around, comparing what your lender can offer you as an existing customer or remortgaging to another lender, it changes a lot at the moment. Which one's going to be the best? It does change daily and weekly at the minute. So by shopping around, looking at both, you can have an informed decision, know which is going to be the most competitive option. So it's definitely better to shop around.
And if you stayed with your current lender, would you not have to go through such an onerous remortgage process? I mean, you mentioned there that it might be faster if you stick with your current lender. Is that one of the appeals, or would you always have to go through that kind of affordability check, providing your pay slips, all of that process?
Yeah, by staying with your existing lender, it can be easy because you don't need to prove the income again. So if you're looking at borrowing extra funds, you might need to prove that. But if you're just doing a like-for-like rate switch, then there's no underwriting required or pay slips, bank statements. You're not going through that process. There's also no legal aspects of it, of moving it from one lender to another. So it is a smoother process, and you may be eligible for existing customer rates. They might have preferential rates. Again, it's always worth checking because it differs a lot. It could be better to move elsewhere or stay with the same lender. So by going through that process, I know it can be a little onerous with the remortgage process and using solicitors again, but it can save you quite a bit of money in the long run by possibly moving to someone else.
And there's been a lot of debate at the moment about whether people who are remortgaging should go on a fixed rate deal or a tracker deal. Before we dive into that debate, can you just explain what those two are, just for people that aren't in the know?
Yeah, of course. The fixed rate versus the tracker, it's a big question we're getting asked a lot at the moment. But to confirm the difference between the two, so you've got your fixed rate mortgage. This is a guaranteed interest rate for a specific period of time. So whether that be 2, 3, 5-year fix or even longer. What that does, it gives you certainly your monthly payments. They remain constant throughout the term. It gives you stability of knowing exactly how much you're going to be paying each month, which will enable you to budget. The tracker mortgage is slightly different. It's a variable mortgage and it's linked to the Bank of England's base rate, so it tracks the base rate. That means it can fluctuate, it can go up and down or remain the same. Now, what the lenders do is they set a marker based on the base rate and with the additional interest percentage. And if the base rate is to go up or down, that'll go in line with your monthly mortgage payment. So although the tracker runs with risk, with the fluctuations, it does offer other flexible features that fixed rate deals may not have, such as possibly no early repayment charges or extra allowances around overpayments, but that is tailored to each individual tracker product. So it's not across all, but it may be a feature that is linked to it.
And so when people are weighing up those kind of tracker or fixed rate and which they should go for at the moment, how do they decide that? And why is that such a big debate at the moment?
It is, and a lot of people are sitting on the fence with this one. And I do wish I had a crystal ball to know what was going to happen in the future. I think we all did with that. The question really, I would kind of say it's whether a fixed or a tracker mortgage is good for you personally. So there's always going to be pros and cons of different products, but it's down to your own circumstances, like attitude to risk and security will all come into play when it comes to answering this question. And I'll be honest, I won't sugarcoat things. The timing isn't great for whichever option you choose, as the market's likely to remain like this until things cool off in the future. But 6 to 8 months ago, trackers were more competitive. Looking at it now, fixed rate deals have been more competitive. So it is really tailored to an individual of what your attitude to risk is, which one's going to be the most affordable. Can you afford the fluctuations? Is a fixed rate going to be the most competitive? We have to look at everything as a whole. So it is a good idea to kind of, as I would say, consult with a broker and look at all options. We can explain the options for you, advise you on the best way forward, so you can make an informed decision on what you feel is going to be the best for you.
And one thing's probably clear at the moment, that trying to anticipate what interest rates are going to do is so hard at the moment, which obviously makes your job very hard.
It is at the moment. They're forever changing. It's quite volatile at the moment. So what I would advise is by reserving a rate with in advance 6 months before, then you're not set in stone with that either. So what I always advise is that if you do lock it in 6 months before, if interest rates are to go up, you future-proof yourself from any interest rate rises. You've locked in that deal. If rates do go down, then it's quite flexible. We can still change the deal for you, so you're not missing out on any lower rates. We can change it with the lender we've put you with, or whether it's moving to another lender. It's quite flexible around that. So if it goes down, bonus, we can change it. But if it goes up, you future-proof yourself on that interest rate rise.
And we know that house prices have shot up in recent years. And so some people might have more equity in their home than they had previously and might want to take that out, whether that's, to do work on the property or for another reason. How easy is that process? Is that effectively you're just borrowing more on the mortgage than you are at the moment?
You can do, so you can release the equity. So you can do that for lots of different things, such as like home improvements, debt consolidation, or possibly investing in a property such as a buy-to-let. You can do that at any time within your mortgage deal. So you could possibly, if you're with your current lender and you've not got a remortgage coming up anytime soon, you can complete a further advance, which will release the equity and give the funds to you sooner. Kind of runs alongside your mortgage account as a sub-account. So it's just the new lending will be on the rate that's available at that time, and they'll run alongside each other. If you do have a remortgage coming up and you want to release equity, you can do that as part of the remortgage process, and you'll receive the funds on completion. One thing I would say to be aware of is that by releasing equity in your home, you are pushing yourself into those higher loan-to-value brackets, which means it might then meet higher interest rates the higher the loan-to-value is. Also, with regards to budget, rates have already gone up. So if your monthly payment has already increased, by taking further equity out, that's going to cost even more again. So just make sure it's going to be comfortably affordable for you with the extra money being released out of your home. And also, house prices can fall as well as rise. So if you've got a lot of equity in your property, then that's great. You're still around those low loan-to-value brackets, even after releasing the equity. But if you are at a higher loan-to-value, then just be careful, because if property prices were to fall, you could end up in a negative position.
And on the flip side of it, lots of people are asking at the moment about whether they should be overpaying on their mortgage. So this is where you pay more than your usual monthly repayments to try and eat away at that mortgage debt a bit quicker. And I think a lot of people are looking ahead to, remortgaging onto higher interest rates and how much more that's going to cost them, and thinking that they might reduce their mortgage debt. What are some of the things that you need to think about if you're weighing up whether you're going to overpay or not?
Yeah, so we always say overpayments are always a good idea if it's affordable to do so. And you can do that via like a lump sum payment or alongside your monthly direct debit. So you can add to the direct debit each month. You do have an allowance. Most lenders will give you a 10% allowance of the mortgage balance each year without incurring any early repayment charges. There's also a window upon renewal. So if you are coming up for remortgage and you want to make an overpayment above the 10% allowance, there's a small window there where you can make that payment just before you lock yourself back into a new deal. So you can get past that 10% allowance without incurring the charges. If the overpayment is going to bring you into lower loan-to-value brackets, even better, because it's going to qualify you for those lower rates of interest. One thing I would say would be if you are looking at using all of your savings to overpay on the mortgage, we wouldn't normally advise that. Keep some funds back, for an emergency fund, especially with the cost of living and things at the moment. Good idea to reduce the term and save on interest overall, but it's also make sure that you've got enough money there just in case.
And I know some people who've kind of roughly worked out how much extra their mortgage is going to cost them, and then they're overpaying by that amount in the run up to remortgaging, which seems very smart and sensible. Is that a good idea?
Yeah, definitely a good idea. If you can afford that and keep that going with the monthly payments as well, it's going to bring that down for you and keep it in line and qualify you possibly for a lower loan to value upon your renewal.
And for those people who are moving at the moment, moving house, maybe moving to the next rung on the ladder, how do they work out, with mortgage rates changing so much at the moment, how do they work out what's going to be affordable in terms of how much they could borrow, and so therefore what their budget is for their new home?
Yeah, so it's an exciting time to be moving home and on to the next step on the ladder, but it can also raise a lot of questions given the current market. So it's a lot of questions in whether it's the right time, what's it going to cost, can I afford that dream home? I've been stalking on Rightmove for the last week. Yeah, there's lots of tools out there online which can help you with this. You've got your affordability calculators, which will determine your income and your outgoings, such as your credit commitments and financial dependence. That can give you an idea of roughly how much you can borrow. Again, consult with an expert such as a broker. They know the knowledge and the criteria around incomes and maximum lengths across the market to make it achievable for you, because it's not one size fits all when it comes to income with the banks and the lenders. They've all got different policies and criteria, so it's making sure that it's definitely affordable and you do fit within the criteria. It's also around budget. Again, so within the rate rises, making sure that that move's going to fit within your means and your lifestyle. So it might be okay moving to that dream home, but you don't want to be overstretching yourself in the current climate. You want to make sure that you do get the dream home, but it's also going to be comfortably affordable for you as well. So by working out your maximum affordability, what's it going to look like monthly, possibly getting a mortgage in principle, I would advise to do that before you put your house on the market and start offering on other properties, so it puts you in a really good position.
And I guess that kind of how much is affordable personally, that's such a personal judgment, right? Some people might be more comfortable putting a much higher proportion towards their mortgage, where other people, want to spend money elsewhere. Some people might be comfortable maxing out and assuming that their income, is going to rise in coming years. Other people might be more conservative. So I guess there's no hard rule of thumb there, is there?
Yeah, it's not. It's all tailored individually. It's like you say, different people have different lifestyle, how much money they want to spend on different things, whether it's the mortgage and holidays and with the kids and things. It does depend individually what's going to be affordable. The lenders do set a set amount, for the maximum lending amounts. But again, they all differ as well. So each lender lends different amounts. Some might lend slightly more than others. So it is good to review everything as a whole across the board and see what you can achieve and what your maximum lending is with each lender.
For people out there who are either remortgaging or moving to a new property, or even first-time buyers who are feeling a bit kind of spooked and scared by the mortgage market at the moment, particularly with so many headlines about rates rising and kind of panic in the mortgage markets, what advice would you have for those people who are feeling a bit nervous?
It is. It's one of those times at the moment, isn't it? Everybody's not sure what to do. What's the best way to move forward? My advice would be, if you are looking to move home and once you've assessed that affordability and looked at how much it's going to cost, if that still feels comfortably affordable for you and you've found your dream home, go for it. If that's going to fit. If it's a little bit out of reach at the moment, you might want to kind of wait for things to see if they do start to settle, or look at a lower budget, or a different type of property. But we are saying if it's affordable and you feel that that's going to be achievable for you, once you've spoken and received that advice, then to go for it.
Amazing. Thanks for all of your tips. I know it's such good practical advice there for people. Thank you.
No problem at all. Thank you.
Charlotte Tollett there, and you can find the Meet Margot team on social media. They have really great videos breaking down a lot of the jargon in the mortgage industry, or some of the questions that you might have at the moment. So check them out. And you can also take a look at their app, which is meetmargot.co.uk.
Yeah, I find it incredible, the stuff that you can get on social media now. There's some really clever tips and tricks. So if you are thinking about buying a house, or taking out a pension or anything like that, it's really worth having a look. And of course, it's always worth having a look at our Money Matters pages as well. Now, one of the things that we do always ask our guests to do is to share a financial confession. This is Laura's favourite bit, I know. And Charlotte's one is a perfect happenstance because it's all about her experience of being a first-time buyer.
Okay, so biggest money mistake, I would say, is being a first-time buyer. You save everything for your deposit and your solicitors and all your stamps, you do all of that kind of together. But one thing I didn't kind of budget for is actually when you move in the property, the items that you need when you move in, such as your large items such as sofas and kitchens and appliances and things like that. Now, there's so much available at the moment, 0%, you can pay it off over so many months and things like that. So you can get carried away, a bit blindsided with all new shiny things to go in a new nice home. But you need to remember that they are financial commitments. Like I didn't at the time, those little ones add up and they go out alongside your mortgage and your bills as well. So by moving in, it was just a bit of a shock when you've got all the items as well as the mortgage and things and not budgeting for that once you've moved in. So yeah, just remember they are stuck with you for quite some time.
I think this is so common. I think so many people budget for the deposit, for the surveyor costs, for all of those costs associated with buying a home. And then they move in and they think, oh God, I've only got like one piece of furniture that I had in my rented property, or I've got a mattress but not a bed, or I didn't realise how expensive washing machines were. That was definitely a shock to me when I moved into my first property, how pricey dishwashers and washing machines were.
For me, it was paint.
So
because
Yes.
you know, if you want a really nice colour and you've got your little paint sheets out and you've gone with something really posh, and then first of all you realise how much you need, and second of all how much tin costs.
I know. Yeah, you're right. All of those things that you just have never had to encounter before because you've been renting, suddenly they really add up.
That's it for this episode of Money Matters. Do get in touch on social media. We would love it also if you'd sign up to our newsletter so that you get all the information about future podcasts. Laura was talking about one on student loans that we're going to do. We'll make sure that you get notification that that is coming up, and also loads of helpful articles aimed at helping women feel good about their finances and investing.
Yeah, you can sign up on our website, ajbell.co.uk/money matters. I've also just written an article about how the taxman is coming for your savings and how to make sure he doesn't get his clutches on your savings interest. So definitely check that one out. And we would also always love to hear from you guys, whether you want to recommend a topic or a particular guest. Definitely get in touch with us either on Twitter or Instagram, or you can email us at moneymatters@ajbell.co.uk.
And don't think financial confessions are just for our guests. We'd be delighted if you wanted to share one with us. We love hearing about your financial journeys. Until next time, thanks so much for listening. Bye.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you whether certain investments are suitable or not. And don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that tax rules apply, and that the way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.